So let's look at debt. Now, debt modeling can get quite advanced. So in this video, we're going to give you the key principles of debt modeling within a three-way financial model. To do this, we're first going to jump straight into our financial statement impacts. So we're going to look at how we can split the financial statement impacts of debt into two main sets, as each of these have balancing effects on the financial statements. The first set of financial statement impacts are the debt balances themselves. This is what's commonly referred to as the return of capital. We call this the return of capital, as from the perspective of the providers, such as a bank, when these debt balances are repaid by the business, they get the return of the capital that they have provided. Now, it's important to note that these balances do not affect the profitability of a business. The drawdowns and repayments of debt are included within the financing section of the cash flow statement, with the net movement changing the change in cash held and therefore change in cash at bank. In this example, with the drawdown of 200 and a repayment of 100, we have a net change in cash held of 100, increasing cash at bank by 100. This is matched by an increase in our debt balance within the non-current liability section of our balance sheet. This increase in our liabilities matches our increase in our total assets, ensuring that net assets and total equity remain balanced and our balance sheet balances. The second set of financial statement impacts are the interest expense on the debt itself. This is what we refer to as the return on capital. We call it the return on capital as from the perspective of the provider, such as the bank. This is their return or compensation for the risk of lending your business money. What's interesting about the interest expense is that it's reported as an operating expense and included in the income statement, and the payment is included within the operating section of the cash flow statement. We also adjust for any interest expense which is not yet paid by increasing our interest payable within the current liability section of our balance sheet. Whenever debt is being analysed within a three-way financial model, you can always break the impacts of debt into these two main sets, the return on capital and the return of capital. The return of capital, again, being the change in the debt balances themselves, and the return on capital being the interest expense and the payment of this, as well as the adjustment for that outstanding. Now, hopping back into our financial model, when we first bring in your historical debt balances, they're brought into your historical balance sheet within your non-current liability section at the bottom of the balance sheet. You can see in this example here that we have three categories, those being bank debt, commercial paper, and our working capital facility, and we have their historical balances on the right-hand side of the sheet here. If we scroll across our time series until our most recent historical month, that being June 22, we can see that we have our closing balances here, and if we're looking at bank debt, for example, we can see we have a closing balance of 1440.0 for the month of June. We also bring in your historical interest expense from your accounting package into your historical income statement, with the interest expense being located at the bottom of the income statement below your interest on cash. You can see here that we have our three interest expenses for our three debt facilities, being bank debt interest, commercial paper interest, and working capital facility interest, with the historical expenses on the right-hand side of the sheet. Now, when we forecast your debt balances, this is handled on the capital sheet, and you can see that we have our three main debt tranches here of bank debt, commercial paper, and our working capital facility, all being brought through from the historical balance sheet. Now, looking at our bank debt facility, you can see that we have our opening balance of 1440.0 being brought through from our historical balance sheet. When looking at our analysis, we can see that we have our drawdowns and repayments at the top of our debt facility, this being our return of capital. Below this, we then have our interest payable and paid calculations, this section then being our return on capital. If we look at the October 22 month, for example, we currently have no change in drawdowns or repayments for the month. If we wanted to forecast a repayment of, say, $100 of debt, if we enter our assumption of 100, you'll then see that we have our opening balance of 1440 less our repayment of 100, giving us a closing balance of 1340. This is our return of capital for our bank debt facility. Below this, we are then calculating our interest expense for this facility as well. Currently, we have an 8% annual interest rate for the facility, and below this, we then calculate the effective monthly rate based on this. When we calculate our interest expense for our debt facilities, we apply the effective monthly rate to the opening balance of the period. In this case, 1440 multiplied by our 0.67 monthly interest rate gives us our interest expense of 9.6. We can then see below that we're currently assuming our interest expense is paid in cash in the month it is incurred, therefore leaving us without an interest payable balance. If we want to see the financial statement impacts within our model, firstly looking at a return of capital with our repayment of $100, we can head back to our table of contents and activate our financial statements. If we first head to our balance sheet and expand our debt collapse rows within our non-current liabilities, we can see that we have our bank facility at the top. If we scroll across our time series until we get to our forecast month of October 22, we can then see that we have our closing debt balance of $1340 for the month of October, down $100 from the previous balance of $1440 in September 22. Coinciding with this decrease of $100, if we scroll down to our cash flow statement and expand our debt repayment section within our financing cash flows, we can then see that we have our $100 payment for our bank debt facility coming through. If we then head back to our table of contents and reactivate our capital sheet, looking at the month of October, we can see that we have an interest expense of 9.6, which is then consequently paid within the same period as well. If we then head back to our financial statements and head back to our cash flow statement initially, looking at the month of October, we can then see within our operating cash flow section, if we expand our interest paid, we can then see in our forecast interest paid for bank debt debt, we have our 9.6 for October 22 hitting our cash flow statement. If we then scroll to the top of the sheet and look at our income statement and expand our net interest expense collapse rows, we can see within our forecast interest expense categories, again for October 22, we have the expense of 9.6 hitting our income statement. This shows that when you're looking at debt within a three-way financial model, you can always split out the financial statement impacts into those two main groups, the return of capital and the return on capital. Now, when looking at a full three-way financial model, the only other area of analysis that debt affects is the interest expense on the income statement having implications on the tax expense of a business from a corporate taxation perspective. Now, again, this will be handled within its own video. However, for the purposes of this video, when we're looking just at the impacts of debt within a three-way financial model, again, to recap, we have two main sets of financial statement impacts. The first being the return of capital, that being the debt balances themselves. Debt is a non-current liability on the balance sheet, with the debt drawdowns and repayments associated with this included within the financing section of the cash flow statement. In addition, we then have our return on capital, which is our interest expense. This is included below EBITDA on the income statement, and the payment of this is included within the operating section of the cash flow statement. And finally, any interest expense which is yet to be paid in cash, we then adjust for within the interest payable balance in the current liability section of the balance sheet. So while we'll cover more advanced debt modeling in other videos, the key takeaway from this video is that whenever you're looking at debt within a three-way financial model, always remember the two main sets of financial statement impacts, the return on capital and the return of capital.